Welcome students, my name is Vijaya. In this we are going to see unit number 15, factoring, forfeiting and credit rating from block 4, fund-based services topic. Factoring. Factoring may be defined as selling the receivables of a firm at a discount to a financial organization, that is factor. The cash from the sale of the receivables provides finance to the selling company client out of the difference between the face value of the receivables and what the factor pays the selling company, that is discount. It meets its expenses, collection, accounting, etc. The balance is the profit of the factor for the factoring services. Factoring can take the form of either a factoring agreement or an assignment, that is pledging agreement. Objectives of factoring. The important objectives are as follows. It is the responsibility of factor, timely follow-up is done and appropriate strategies are formed by the factor that save time and efforts, manpower, wastages. Number 2, the factor provides up to 80% of the cost of goods sold in advance, which reduces financial burden on the client. Sometimes the factor provides full credit protection against bad debts. Number 3, the factors aims to scrutinize all information regarding outside balance, credit time period due, information from credit rating agencies, trade references, banking reports, etc., which helps in better credit control. Number 4, it tries to accelerate the turnover of receivables, which results in higher sales and return on investment, allows the client to expand his business, etc. The last point, it aims to provide the following advisory and consultancy services to client, like guide the client about market by trends of his or her products, assessing credit worthiness of the customer, systematic analysis and credit recovery, issuing letter of credit and auditing, and dealing with sales return. Next, we will see types of factoring. There are different types of factoring. These may be briefly discussed as follows. First, recourse factoring. In this type of factoring, the factor only manages the receivables without take any risk like bad debts, etc. In this, full risk is borne by the firm, that is client itself. Next type is non-recourse factoring. Here, the firm gets total credit protection because complete risk of total receivable is borne by the factor, and this is also called full factoring. The client gets 100% cash against the invoices, that is arising out of credit sales by the client, even if bad debts occur. For the factoring service, the client pays a commission to the factory, so it is called as full factoring. Next, maturity factoring. In this type of factoring, the factor does not pay any cash in advance. The factor pays clients only when he receives funds, that is collection of credit sales from the customers, or when the customers guarantee full payment. Next, we move on to the advance factoring. Here, the factor makes advance payment of about 80% of the invoice value to the client. Next type is invoice discounting. Under this arrangement, the factor gives advance to the client against receivables and collects interest, that is service charge, for the period extending from the date of advance to the date of collection. Next, we move on to the undisclosed factoring. In this case, the customers, that is debtors of the client, are not at all informed about the factoring agreement between the factor and the client. The factor performs all its usual factoring services in the name of the client or a sales company to which the client sells his book debts. Through this company, the factor deals with the customers. This type of factoring is found in UK. Next, we move on to the cross-border factoring. It is similar to domestic factoring expert that there are four parties, that is exporter, export factor, import factor and importer. It is also called two-factor system of factoring. Exporter, that is client, enters into factoring agreement with export factor in his country and assigns to him export receivables. Export factor enters into agreement with import factor and has arrangement for credit evaluation and collection of payment for an agreed fee. Notation is made on the invoice that importer has to make payment to the import factor. Import factor collects payment and remits to export factor, who passes on the proceeds to the exporter after adjusting his advance, if any. Where foreign currency is involved, factor covers the exchange risk also. Next, we move on to the features, that is nature of factoring. From the following essential features of factoring, we can understand its nature. Factoring is a service of financial nature. It involves the conversion of credit bills into cash, account receivables and other credit dues resulting from credit sales appear in the books of account as book credits. Number 1, it is very costly. Number 2, in factoring there are three parties, that is the seller, the debtor and the factor. Number 3, it helps to generate an immediate inflow of cash. Number 4, here the full liability of debtor has been assumed by the factor. Number 5, factor has a right to take any legal action required to recover the debts. Next, we move on to the functions of a factor. Factor is a financial institution that specializes in buying accounts receivables from business firms. A factor performs some important functions. These may be discussed as follows. Provision of finance. Receivables or book debts is the subject matter of factoring. A factor buys the books debts of his clients. Generally, a factor gives about 80% of the value of receivables as advance to the client. Thus, the non-productive and inactive current assets, that is receivables, are converted into productive and active assets, that is cash. Second function, administration of sales ledger. The factor maintains the sales ledger of every client. When the credit sales takes place, the firm prepares the invoice in two copies. One copy is sent to the customer and the other is sent to the factor. Entries are made in the ledger under open item method. In this method, each receipt is matched against the specific invoice. The customer's account clearly shows the various open invoices outstanding on any given date. The factor also gives periodic reports to the client on the current status of his receivables and the amount received from customers. Thus, the factor undertakes the responsibility of entire sales administration of the client. Next function is collection of receivables. The main function of a factor is to collect the credit or receivables on behalf of the client and to relieve him from all tensions, problems associated with the credit collection. This enables the client to concentrate on other important areas of business. This also helps the client to reduce cost of collection. Then we move on to the next function, protection against risk. If the debts are factored without resource, all risk relating to receivables, that is bad debts or defaults by customers, will be assumed by the factor. The factor relieves the client from the trouble of credit collection. It also advises the client on the credit worthiness of potential customers. In short, the factor protects the clients from risk such as defaults and bad debts. Next, we move on to the credit management. The factor in consultation with the client fixes credit limits for approved customers. Within these limits, the factor undertakes to buy all credit debts of the customer. Factor assesses the credit standing of the customer. This is done on the basis of information collected from credit rating reports, bank reports, etc. In this way, the factor advocates the best credit and collection policies suitable for the client. In short, it helps the client in efficient credit management. And the last function is advisory services. These services arise out of the close relationship between a factor and a client. The factor has better knowledge and wide experience in the field of finance. It is a specialized institution for managing account receivables. It possesses extensive credit information about customers' credit worthiness and track record. With all these, a factor can provide various advisory services to the client. Besides, the factor helps the client in raising finance from banks, financial institutions, etc. Next, we move on to the advantages and disadvantages of factoring. First, we will see what are the advantages of factoring. First point in advantages is it improves efficiency. Factoring is an important tool for efficient receivables management. Factoring relieves the clients from both creation of bad debt collection. Higher credit rating. Factoring generates cash for the selling firm. Next, reduces cost. The client need not have a special administrative setup to look after credit control. Next, additional source. Funds from a factor is an additional source of finance for the client. Next point, advisory service. A factor firm is a specialized agency for better management of receivables. Next, acceleration of production cycle. With cash available for credit sales, client firm's liquidity will improve. Next point, adequate credit control period for customers. Customers get adequate credit period for payment of assigned debts. Next, the last point, competitive terms to offer. The client, the firm will be able to offer competitive terms to its buyers, and this will improve its sales and profits. Now we will see what are the disadvantages of factoring. Factoring may lead to overconfidence in the behavior of the client, and this results in overtrading or mismanagement. Next, there are chances of fraudulent acts on the part of the client. Invoicing against non-existent goods, duplicate invoicing, etc. Lack of professionalism and competence, resistant to change, etc. are some of the problems which have made factoring services unpopular. Factoring is not suitable for small companies with a lesser turnover, companies with speculative business, companies having large number of debtors for small amounts, etc. Factoring may impose constraints on the way to do business. For non-recourse factoring, most factors will want to pre-approve customers. This may cause delays. Further, the factor will apply credit limits to individual customers. Next, we enter into a new concept called forfeiting. The term forfeit is a French word. It means to surrender something or give up someone's right. Thus, forfeiting means giving up the right of exporter to the forfeiter to receive payment in future from the importer. It is a method of trade financing that allows exporters to get immediate cash and relief from all risk by selling their receivables, that is amount due from the importer, on a without recourse business. This means that in case the importer makes a default, the forfeiter cannot go back to the exporter to recover the money. Under forfeiting, the exporter surrenders his rights to a receivable due at a future date in exchange for immediate cash payment at an agreement discount. Next, we will see what are the characteristics of future. Converts deferred payment exports into cash transactions, providing liquidity and cash flow to the exporters. Then discharge exporter from cross-border, that is political or exchange risk associated with export receivables. Next, finance available to 100% as against 75 to 80% under conventional credit method without recourse. And it acts as an additional source of funding and hence does not have impact on exporters' borrowing limits. It does not reflect as debt in exporters' balance sheet. Last, it provides fixed rate finance and hence risk of interest rate fluctuation does not arise. Next, we move on to the advantages of forfeiting. The exporter gets the full export value from the forfeiter. It improves the liquidity of the exporter. It converts a credit transaction into a cash transaction. It is simple and flexible, and it can be used to finance any export transaction. The structure of finance can be determined according to the needs of the exporter, importer, and the forfeiter. The exporter is free from many export credit risks such as interest rate risk, exchange rate risk, political risk, commercial risk, etc. The exporter need not carry the receivables to his balance sheet. It enhances the competitive advantage of the exporter. He can provide more credit. This increases the volume of business. There is no need for export credit insurance. Exporter saves insurance cost. He is relieved from the complicated procedures also, and so as is beneficial to forfeiter also. He gets immediate income in the form of discount, so he can sell the receivables in the secondary market or any investor for cash. Now we will see the basic differences between the factoring and the forfeiting. Factoring, it is used for short term, and for forfeiting it is used for medium term financing. Number 2, it may be with or without recourse, and forfeiting it will be always without recourse. For factoring, it's applicable to both domestic and export receivables, and for factoring it is applicable to both to export receivables only. And number 4, normally 70% to 85% of the invoice value is provided as advance, but whereas in forfeiting 100% finance is provided to the exporter. Number 5, the contractor is between the factor and the seller, whereas in forfeiting the contract is between the forfeiter and the exporter. Number 6, other than financing, several other things like sales, ledger administration, debt collection, etc. is provided by the factor, whereas in forfeiting it is a financing arrangement only. Number 7, a bulk finance is provided against a number of unpaid invoices, and it is biased on a single export bill, resulting only a single transaction. Number 8, no minimum size of transaction is specified in factoring, but in forfeiting there is a minimum specified value per transaction. Next, we move on to the new topic, bill discounting. Bill discounting is a trade related activity in which a company's unpaid invoices which are due to be paid at a future date are sold to a financier, that is a bank or other financial institution. In bill discounting, the business discounts the outstanding invoices to gain access to short-term financial assistance and maintain the working capital. This process is also called as invoice discounting. This process is governed by the Negotiable Instrument Act 2010. Factoring and reverse factoring are two methods a bill is discounted on TREDS platform. Both the methods are designed to speed up and increase cash flow without disturbing the balance sheet. That is, trade receivables discounting system that is TREDS, is an initiative of the RBI India to facilitate MSME receivable payments from corporate. The main objective of the TREDS platform is to address the critical needs of MSMEs. Next, we move on to the advantages of bill discounting. Bill discounting reduces the chance of bad debt as the risk of defaults or non-payment by the buyer, importer is borne by the intermediary institutions. It facilitates the seller to improve the cash inflow and hence avoid cash crunch during a trade. Next, typically bill discounting services are provided on a low rate of interest fees as compared to other advanced facilities. Therefore, it is beneficial for sellers. Fourth point, since the bill of exchange is a negotiable or tradable instrument and can be further rediscounted by the central banks or can be sold to other financial institutions, hence processed quickly. Thus, seller will be able to instant backup of funds. The seller, the beneficiary, has to interest on unused amount only, unlike other business loans. And these are some basic differences between the bill discounting and factoring. Bill discounting, first one, finance alone is provided, whereas in factoring, in addition to the provision of finance, several other services like maintenance of sales ledger, advisory services extra are provided. Number 2, advances are made against bills, but whereas in factoring, receivables are purchased by assignment. Number 3, drawer holder is the collector of receivables, whereas in factor is the collector of receivables. Number 4, it is individual transaction oriented, whereas in factoring, bulk finance is provided. Number 5, it is not an off-balance sheet method of finance, but in factoring, it is off-balance sheet method finance. Number 6, stamp duty is charged on bills, whereas in factory, no stamp duty is charged on invoices. Number 7, the grace period for payment is usually 3 days, and whereas in factoring, the grace period is higher. Number 8, it does not involve assignment of debts, but in factoring, it involves assignment of debts. Number 9, bills discounted may be rediscounted several times before the due date, but whereas in factoring, debts purchased cannot be rediscounted. Number 10, it is always with recourse, but in factoring, it may be with or without recourse. Next, we enter into a new topic, credit rating. A credit rating is nothing but a measurement of a person or a business entity's ability to repay a financial obligation based on income and past repayment histories. Usually expressed as a credit score, banks and lenders use a credit rating as one of the factors to determine whether to lend money or not to the businessman. The term credit rating refers to a quantified assessment of a borrower's credit worthiness in general terms or with respect to a particular debt or financial obligation. A credit rating can be assigned to any entity that seeks to borrow money, an individual or a corporation or a state or provisional authority or a sovereign government. And these are the basic characteristics of credit rating. Assessment to issuer's capacity to repay. It assesses issuer's capacity to meet its financial obligations, that is, its capacity to pay interest and repay the principal amount borrowed. Number 2, it is based on data. A credit rating agency assesses financial strength of the borrower on the financial data. Number 3, expressed in symbols. Ratings are expressed in symbols, for example, AAA, BBB, which can be understood by a layman too, done by expert. Credit rating is done by expert of reputed accredited institutions. Number 4, guidance. Guidance about investment, not recommendation. Credit rating is only a guidance to investors and not a recommendation to invest in any particular investments. Next, we move on to the importance of credit rating. Some of the points are very important for the credit rating and why the credit rating is very important in India. Opinion of good credit rating agency is unbiased. Credit rating agencies employ highly qualified, trained, and experienced staff to assess risk, and they have access to vital and important information, and therefore can provide accurate information about credit worthiness of the borrowing company. Credit rating agencies gather information, analyze and interpret it, and present their findings in easy to understand language, that is in symbols like AAA, BB, C, and not in technical language or in the form of lengthy reports. Credit ratings of instruments are published in financial newspapers and advertisements of the rated companies. The public has not to pay for them. Even otherwise, anybody can get them from credit rating agency on payment of nominal fee. It is beyond the capacity of individual investors to gather such information at their own cost. Credit rating helps investors in accessing risk and taking investment decision. When a borrower gets higher credit rating, it increases its goodwill, and other companies also do not want to lag behind in ratings and inculcate financial discipline in their working and follow ethical practice to become eligible for good rating. This tendency promotes healthy discipline among companies. When the debt instruments have been rated by credit agencies, like policies can be laid down by regulatory authorities like SEBI, RBI, about eligibility of securities in which funds can be invested by various institutions like mutual funds, provident funds, trust, etc. Thank you.